BigBear.ai, looking at its recent flip to profitability and asking, is this the big turning point?
Right.
And what I liked right away is that it nails the main nuance. That 2.52 million in net income happened while revenue actually shrank by about 20%.
Exactly.
So the profit came from efficiency, not growth, which is a really sophisticated place to start.
It is. It shows the writer understands that just being profitable isn't the whole story, not in defense AI. But now you have to build the next story.
Yeah, the future narrative.
If this really is a turning point, the growth plan has to be, way more explicit.
That's the challenge, right? The Q3 report solves the profit problem, but it kind of creates a new growth problem.
Okay, so while the core thesis gets that BBAI has to shift from efficiency, which is, let's be honest, cost-cutting, to actual revenue growth, the material leaves that transition path a little too speculative for my taste.
As I'm reading it, the whole argument seems to lean on their cash pile, which is massive, something like $390.8 million. The report calls it a cash fortress, which it is.
And the idea is that this cash lets them do acquisitions or just survive a downturn, and crucially, they don't have to dilute shares.
And that's a strong bullish signal, no doubt. Sitting on that much dry powder is valuable. But here's the weakness. The report never explicitly connects that cash fortress to the how.
The how of reversing the revenue decline? Exactly. How do you fix that 20% contraction? The strategy is just stated as, they must now turn that cash pile into revenue growth. It doesn't say how they should do it.
I see. So it's a huge gap between the resource, the cash, and the goal, the growth.
It is. If the whole turning point idea depends on reversing that revenue drop, then the plan for using the cash has to be the absolute center of the thesis.
Not just like a nice-to-have data point on the side.
Precisely. So the suggestion here is that the memo needs a dedicated section, or at least a few bullet points, that outline maybe 2 or 3 specific high-level ways they could use that cash.
Okay.
That would solidify the turning point verdict and turn this from just a statement into something more like a blueprint.
That definitely makes it more actionable for an investor. But how do you model that? Just saying, do M&A isn't really enough, is it?
No, you have to get more specific on the type of M&A. So instead of just saying they have the runway, suggest modeling the criteria. For instance, what are the priorities? Is the cash for product acquisitions?
You mean things that deepen their AI offering, maybe add some unique IP, but might take a while to actually generate revenue?
Yes. Or is it for contract acquisitions?
Which would guarantee immediate revenue streams, a quick fix for that 20% problem, but maybe those deals are, lower margin or riskier long-term.
Exactly right. And that choice defines the entire growth story. A product deal signals confidence. A contract deal signals, maybe, a need to stop the bleeding on the top line. The memo needs to take a stand.
Okay, but isn't that asking a bit much? Modeling M&A targets requires a lot of assumptions.
We're not asking for specific targets, just the strategic criteria. Or here's another way to do it.
Okay.
Forget M&A for a second. Explore the organic path. How much of that $390 million would need to go into sales and marketing or R&D just to get back to flat, let alone positive growth?
So you're grounding the growth plan in actual numbers.
Right. And, speaking of numbers, I think there's more to do with the capital structure part.
What do you mean?
Well, the writer mentions avoiding dilution, which is great, but we can quantify that.
How so?
The material could actually benefit from modeling the hypothetical dilution risk avoided. So what if they needed to raise that money and diluted shareholders by 10%? You compare that scenario to using the cash for an M&A deal that, say, adds 10% market share without dilution.
Oh, I see. That comparison makes the value of that cash fortress crystal clear. It's not just a pile of money. It's a strategic weapon.
Exactly. It makes the turning point a financially modeled opportunity, not just a hope.
Okay, that's a strong point. Let's move to the second critique. This is about where that profitability actually came from.
Right. For an AI and defense company, the material's positive take on profit from cost cutting, it just needs a bit more scrutiny, a little constructive pushback on the long-term health of the business.
The analysis calls it the efficiency story, and it treats it as a pure positive.
And look, it is a positive. It shows management has fiscal control. But in this sector, high-tech, AI, and defense, deep cuts often mean one thing.
R&D.
Slowing down R&D or worse, letting go of key engineering talent, the people who hold the IP.
So there's a fundamental tension. They might be cutting the very teams they need to win the next big government contract. The path to profit could actually be undermining the path to growth.
That's it, right there. So the weakness is treating efficiency as this unalloyed good without talking about the trade-off. The suggestion then is to bring in a counter-argument, a risk factor.
You have to ask what was cut to get to that $2.52 million in net income.
Yes, it just adds intellectual honesty and makes sure the reader is thinking about both sides of the efficiency coin.
And for a script especially, you need a powerful way to frame that risk.
Of course, I'd suggest a section on the operational trade-off. Instead of just applauding the profit, the analysis should be asking, did it come at the expense of capital spending, servers, or key talent?
You need a line that just captures it.
Yeah, something like, while efficiency is welcome, the fundamental question remains, are they cutting fat or are they cutting muscle?
That line says it all. It forces you to think critically about what management's actually doing.
And to really ground that, you need context. I think the writer should be explicitly advised to compare BBAI's operational expense cuts to its peers,
Like Palantir?
like Palantir or other government contractors. If BBAI's cuts are, say, 15% steeper than everyone else's, that's a huge red flag that needs explaining in the memo.
That's a great point on benchmarking. If their cuts are way more aggressive, you have to ask why. Is it brilliant management, or are they just kicking the can down the road on R&D?
And conversely, if the cuts are in line with the industry, then it supports the idea that this is just smart streamlining.
Right. That external data really deepens the analysis. Okay, that's highly actionable. Let's shift to the last point, which is about structure and just the overall punch of the piece.
Yeah. The report's potential for a really powerful valuation argument gets a little bit diffused because the comparison of Palantir shows up early. But then the full weight of what permanent profitability means, that's delayed until the conclusion. The pacing just feels a little off.
And it's a fantastic comparison. The writer points out BBI trades at, around 11 times sales, while Palantir is up at 20 to 30 times sales?
Right.
So the logic is, if this new profitability is for real, BBI could re-rate and close that gap in a big way.
That's the whole long-term thesis right there. That 11x versus 20x gap is the most compelling reason to invest.
But here's the weakness in the structure. That powerful argument is separated from the verdict section. The verdict then pivots to focus mostly on short-term technicals, like the $5 support level.
So you lose the momentum.
Yeah, you present this huge upside potential, the re-rating, but then you immediately pivot to short-term risk management. It just weakens the conviction of the long-term thesis.
It really does. So the suggestion for improvement is critical here. Resequence the whole flow. You need to fully bake that valuation gap into the turning point conclusion.
So the profitable quarter is the catalyst.
It's the catalyst that triggers the re-rating. You have to use the Palantir comparison to define the massive upside before you talk about the short-term risk at $5.
Structurally, you lead with the promise, then you follow with the caveat.
Exactly. A concrete example. You reframe the verdict section to lead with that valuation gap. It needs to start strong. Something like, the true turning point isn't just the profit. It's the potential for a market re-rating that this profitability unlocks.
And then you get into the numbers.
Given peers like Palantir trade at 20x sales, this fundamental shift could completely change BBAI's multiple. You lay out that upside, then you follow up with the $5 support level as the downside protection. It just flows so much better.
Enhances the conviction, for sure.
For sure. And another small thing, the analyst targets the 633 to 667 range.
Yeah.
Frame those as stepping stones. They're just the first step on the path toward that much larger, peer-driven 20 times sales potential. It connects the fundamentals to the big picture scenario.
You know, I'm wondering if we should be even more aggressive with the pacing. What if you moved the conclusion to come right after the financial pivot section?
Oh, interesting.
You'd present the core data, the profit, then immediately hit them with the high conviction verdict based on that re-rating potential. You hook the reader, and then the technical analysis at the end is just a risk management layer.
That's a really sharp observation, especially for a script. You want to deliver the biggest payoff right after the biggest change.
Yeah.
The technicals are important for risk, but they're secondary to the fundamental shift in the business.
That restructuring would make the whole piece feel much more dramatic.
Okay, this has been a really good dive into refining this memo. It's about taking a strong analysis and turning it into a truly high-conviction thesis. Let's just quickly recap the 3 core areas for improvement.
Yep. So 3 actionable areas. First, clarify the strategy for using that huge cash pile to drive revenue. Define the mechanism for growth. Right, whether that's specific M&A criteria or focused R&D spending.
Second, provide some constructive scrutiny on where those cost cuts came from. That key distinction between cutting fat and cutting muscle. And use peer data to back it up.
And finally, restructure the piece to maximize the impact of that valuation comparison to Palantir. You need to move that powerful 11x versus 20x sales argument so it anchors the final verdict, with profitability as the catalyst.
Exactly. Make those 3 changes and you'll have a professional-grade investment thesis. Thank you for submitting your work.
And we would absolutely welcome a resubmission once you've had a chance to incorporate these ideas. We look forward